Welcome to the Quarterly Economic Lens, where we bring clarity to the global and local forces shaping politics, markets, and investment decisions. I'm Sanisha Packirisamy, Chief Economist at Momentum Investments, and joining me is our economist, Tshiamo Masike, as we break down the economic forces that are set to define 2026. The year 2026 has begun with a jolt. President Donald Trump's return to the center of global policymaking has brought geoeconomic supremacy back to the fore. Trade is being rerouted, supply chains are being re-engineered, and politics is once again being wielded as an economic instrument of power. These shifts are the legacy of a pivotal election cycle in 2024, when voters across Western democracies rejected incumbents and the political center, ushering in governments further to the left and right. 2 years on, and the realities remain stubborn. Geopolitical rivalry, the need for economic reform, and deepening political polarization have not disappeared. They have intensified. From US policy uncertainty and Europe's fiscal and political fault lines, to China's economic reorganization and South Africa's reform path under a new political configuration, we will explore what this evolving global order means for growth, stability, and investor confidence. Tshiamo, it's a pleasure to have you with us today to peek into the economic crystal ball. But before we look into 2026, let us take a step back. At the start of 2025, markets and policymakers had certain expectations, from steady US growth and contained inflation to more stable geopolitics in Europe and Asia. But those forecasts whipsawed during the year, particularly after President Donald Trump's tariff announcements in early April, which sent projections up and down as markets tried to price in uncertainty. Looking back now, what were the biggest political and economic surprises of 2025? And which assumptions did market get most wrong, where reality veered sharply from the consensus?
Thank you, Sanisha. So 2025 was indeed quite a roller coaster, and we had a couple of economic surprises, both economic and political, but I'll touch on a few key ones here. You already touched on the trade tariffs back in April, so that is Liberation Day. I think the biggest surprise to the market here came to the extent of the tariffs. We saw some countries were imposed 40%, almost 50% tariffs. So that massive tariff rate was quite a shock to the market. But over the course of the year, we did see that tariff deals came through and the US effective rate came down. And we also saw what became known as taco. So Trump always chickens out. But on the back of the tariffs, we did see that growth was revised down and inflation estimates were revised up. And I think this is where the market also got it wrong, because the reality here was that the global economy was quite resilient. So the IMF has economic growth forecast of 3.3% for 2025. And this is an improvement compared to its estimate of 2.8% back in April, so when we had the tariffs. And even with the longest US government shutdown, we did see that the economy was quite resilient. Key factors that contributed to this resilience included the quick supply chain adaptation that we saw. And this is quite interesting because we didn't see the same thing during the pandemic. But there was also major investments in AI, which then boosted economic growth. Another key surprise to the market was the direction of the dollar. So when President Donald Trump was re-elected as the president, it was expected that the dollar would strengthen, but it did the opposite. It actually weakened. So the dollar weakened by 10% in the first half of 2025, and that speaks to how his policies undermined the role of the dollar in the global economy. Another massive surprise was the gold price. It actually surpassed 4,000 US dollar per ounce, and more recently 5,000 US dollar. So this does speak to the increased geopolitical tensions, but also Trump's policies, which are undermining the dollar.
So hang on to that gold jewelry. There's been a lot of talk about the end of globalization, yet the data tells a far more nuanced story. The latest January estimates from the International Monetary Fund suggest that global trade volumes grew by 4.1% in 2025. This was even higher than the 3.6% print that we saw for 2024. Now, if globalization is not dead, but rather reorganizing. How would you describe the economic reordering that is underway for 2026? And which supply chain shifts and new trade deals should investors be paying attention to?
So those IMF trade growth statistics were actually quite interesting. And a part of why we saw trade growth increasing as much as it did is that we had front loading in anticipation of the tariffs. But what we are seeing on a longer term basis is that we are seeing a shift from cost optimized supply chain to resilience focused supply chain. So this can mean that supply chains will now be longer as opposed to shorter, but it will be security for countries, for companies. What we can expect more of in 2026, we can expect more trade diversification. So we will see countries looking into other markets to export their goods, but also looking into a different product mix of the things that they export. We can also potentially see rerouting. We also already saw this with China in 2025, where they were using their Southeast Asian counterparts to export to the United States. So even though trade with the United States decreased, overall China did have a trade surplus in 2025. Some of the key trade deals that we have to look out for, or rather markets can look out for in 2026, is that Mercosur and EU agreement. So this is between the EU and some South American nations. And what this will do is will essentially cut 90% of the tariffs between the two regions. And this will become, if it passes, it will become the biggest free trade area agreement that we've seen. So you have people who are for this agreement and you have people who are against this agreement. The ones who are for this agreement feel like it should come soon because then these regions can protect themselves against punitive measures from Trump. But you're also seeing that European farmers are saying that their businesses are at risk because then you can't get cheaper goods coming into the country, which will hurt their businesses. Then we have the current US China trade truce. It's expiring in October, so it will be interesting to see the developments that come through over the course of the year. Trump is expected to go to China in April, so I think the market will also look to see if there are any sides of trade negotiations that happen between the two. But we are seeing that the United States is approaching different countries differently, depending on how much of a threat they pose to the United States. So, for example, China has more political leverage, so they are treated a little bit more differently. Another thing is that we are expecting a ruling regarding the legality of Trump's tariffs. So, what this will do is this will impact only the 10% baseline tariff and the reciprocal tariffs, so not the tariffs that we saw on steel, aluminum, and automobiles.
Well, knowing Trump, there are other tariff loopholes that he can potentially manipulate.
100%.
In 2025, the global story was one of economic convergence. Albeit at a slower pace than in 2024, the US entered the year 2025 with stronger momentum. Europe and the UK lagged, while China continued to grapple with weak demand. But if we fast forward to 2026, we can see that that alignment has now fractured. What do you think pulled these economies onto different paths? And how does the outlook for growth now diverge across the major economies? So, yeah, I'm thinking the US, Euro area, UK, Japan, and China.
Mm. So, what pulled these economies apart, I think, is the domestic factors started dominating, right? So, the United States was quite resilient in 2025, and it's expected to continue being resilient in 2026. The IMF is forecasting the US to grow by 2.4%, and this is underpinned by strong household balance sheets, but also AI investment is expected to continue, which is also then expected to continue supporting economic growth. The euro area is expected to continue struggling, even with the fiscal stimulus that we are seeing in Germany. So this region is expected to grow at only half of what the United States is expected to grow, so just 1.2% in 2026. Moving on to the UK, we are seeing that past monetary policy tightening and weak investment continues to keep growth below trend. Japan now, we are seeing that there are potential upsides that can happen to this economy. And this is because of the new prime minister and her friendly growth policies. This is not something that we are seeing in other regions. China continues to struggle with demand. Here, weak confidence among consumers, but also the property market is still struggling.
After years of inflation shocks and aggressive tightening, the global monetary cycle turned in 2024. The US and parts of Europe moved gradually. Others eased more decisively, while Japan was still testing whether or not inflation would stick. With growth diverging across economies, how do the inflation outlooks and expected monetary policy paths differ across these markets that we've now just discussed?
So, if we are expecting growth to diverge, then we are also expecting the inflation and the monetary path to diverge amongst the region that we've just spoken about. For the United States, inflation is still expected to remain above targets. So the Fed is anticipating that inflation will be 2.4% in 2026, but also core inflation there is still quite sticky. And we have risks to the inflation outlook. These include the delayed tariff effects, wage inflation, and fiscal stimulus. From a rates perspective, the market is expecting two 25 basis point cuts by the end of 2026. When we move to the UK, inflation there is expected to fall back into the target, so around 2%. And therefore, we're also expecting gradual cuts, so two 25 basis point cuts are expected in 2026. When we move to the euro area, inflation is quite contained, so the central bank there is not expected to move rates this year, so they're expected to stay steady. Japan, again, is our outlier in this regard. Here, they are still tightening to lock in that exit from deflation. So we're expecting two 25 basis point hikes. China, they are going to remain in an easing mode because they are still struggling with that weak demand and excess capacity is driving disinflation.
It sounds like the bulk of that monetary easing really happened over 2025.
It certainly did.
So let's stay with the US. Beyond inflation and growth, markets are increasingly focused on political pressure, fiscal dominance, and the independence of the Federal Reserve. With Fed Chair Jerome Powell now seemingly juggling interest rate expectations and construction overruns of the Fed headquarters in equal measure. What are the key risks to the US interest rate outlook for 2026? And more broadly, how important is institutional credibility for markets in an increasingly polarized global environment?
So the key risks to the interest rate outlook of the United States, I think it's Fed independence. Jerome Powell's term ends in May of 2026, and this opens up a window of opportunity for President Trump to appoint someone in there who is going to be aligned with his view of where rates are and where they should go. Essentially, that interest rates are currently too high and they need to come down. So this does introduce then a risk of aggressive cuts than what is currently being priced in. But with that said, the FOMC, so the Federal Open Market Committee, that structure there is quite decentralized. So you have 12 voting members, and this does then limit the extent to which political influence can impact monetary policy decisions. So it does act as a form of institutional safeguard. Another key risk to the interest rate outlook is possible higher inflation due to increased protectionism. And if this happens, then we can potentially get less than the two cuts that are currently being priced in by the markets. But you speak about the credibility of institutions in the United States, and we are seeing that that is being increasingly undermined, right? So if we do see that there's credibility loss, this could lead to further dollar weakness. Inflation pressures could possibly then re-emerge, higher gold prices, and greater volatility in US treasuries.
So, still a bit of risk inherent in that US market. We also know that fiscal stress is becoming more visible across advanced economies. Over the past year, we've seen developed market bond yields rise as markets have now pushed back against heavy government spending and rising debt levels. Which regions or countries look most vulnerable in 2026? And how can these fiscal pressures start to spill over into broader global markets?
So what we are seeing is that the bond market is actually acting as some sort of disciplinary force. So it's requesting higher yields for economies that are actually overspending. So governments that are overspending are requested higher yields. A key example here is France, where their government expenditure ratio is actually one of the highest. And markets have started to punish France. We saw this through credit rating downgrades and higher yields. Moving to the US, we are seeing that there's a lot of political pressure that is keeping deficits above 6% of GDP. There's also a lot of fiscal risk that is still coming through. We have the midterm elections that is still coming up this year, but we're also seeing that there's a lot of support for defense spending. So it does introduce a risk to the fiscal spending in the United States.
Elections in recent years have delivered more polarized outcomes across both advanced and emerging markets, complicating economic reform and weighing on investor confidence. Now, in contrast, South Africa has remained relatively stable at the national level. But how can the upcoming municipal elections reshape local governance and influence investor sentiment?
So, the municipal elections or local government elections are expected to take place between November 2026 and January 2027. And the outcome of that is going to be quite important because municipalities are really there to deliver on the basics. So, the outcome of the elections can have an impact on things like service delivery, electricity, and water infrastructure. We do have some data. So, we have a poll from the Social Research Foundation which has the African National Congress at 37% of support nationally as of November. And then we also have Democratic Alliance at 32%. While now this is national polls and it doesn't necessarily mean that the results will filter through to local elections, it does indicate to us that there is increased possibility of coalitions even in major urban areas. So you have a political analyst that has indicated that the ANC and DA could potentially together secure 60%, between 60% to 65% in most urban areas, apart from Cape Town, which does then reiterate the fact that coalitions are likely. While coalitions can have an increased chances of political fragmentation, but I will say that there is also opportunity and that we can't shy away of. So we can potentially see more fiscal discipline come through. You have key metros, and I think those are going to be quite important to watch out for. You have Johannesburg, Cape Town, Tshwane as the key metros, and they are key from the perspective of GDP, from the perspective of growth, and from the perspective of investments. So, if we do see a shift towards more credible governance and commitment in these metros, this would be viewed quite positively. But then again, if there is renewed instability, it could weigh on sentiment. From a market perspective, what could happen following the election results is that if the coalitions that are formed are deemed quite positive, then on the short term, we can have a positive result on sentiment. But over the long term, the market will look for more evidence based. So they will look at things like, is service delivery improving? Is municipal finances improving? So we will have sort of like the GNU, where sentiment increased, but over the long term, then you are looking for more evidence.
The proof is in the pudding.
Correct.
Structural reform has been a recurring theme in the local landscape. Which areas matter most for lifting growth this year? And where do you think that progress is still falling short?
100%. So, structural reform is quite important for South Africa's medium to long term growth. And I think it also still underpins our economic growth forecast, where we're expecting growth to increase over the medium term. The most important would be in energy, so the energy sector. We have seen a lot of improvement in terms of the generation capacity. So, private sector has also come in here and has helped a lot. But the constraint now is on the transmission. The new strategy that was unveiled by government, where they are proposing that generation, transmission, and distribution all fall under one ESCOM holding company, is quite a concern because it's opposite to what was actually promised. So the concern here is that it can actually limit private sector investment into transmission. So we may find ourselves in a situation where we actually get a return of load shedding, but generation capacity is increasing in the country. Logistics remains a key driver of economic growth. Here, we are also seeing operational improvements in Transnet, but also private sector participation. But in this sector, I think we need to see a whole lot more functional concessions come through. Water, I think, is where we need to pay close attention to in 2026 and moving forward. The big national projects are quite progressing quite well. The problem now is at that last mile, so getting water from municipalities to local businesses and to consumers. We know, yes, municipalities do not have a lot of finances that they can play around with, but that infrastructure does need to be dealt with.
Not quite the linear path we would want, but there's a lot of good that you've announced now that I think will actually help South African growth in the longer term. Across the globe, rising geopolitical tensions and shifting power dynamics, especially in the Western Hemisphere, echoing doctrines of the Monroe era, are created a more fragmented international order. South Africa is also navigating this complex landscape. What does this changing global environment mean for trade, capital flows, and policy choices?
Fortunately, South Africa does have a benefit of diverse markets, especially in Asia and the Middle East. But our relationships with the United States are quite strained, right? And they are fragile at this point. So, our role in BRICS, including joint exercises with China, Russia, and Iran, are increasing strain on that relationship with the United States. We saw recently that Canada was actually threatened with 100% tariffs if they sign a deal with China. So what this means is that the US trade policy can now is more depending on politics rather than economics. And this is a risk for countries that are seen as not aligned, such as South Africa. So therefore, South Africa really needs to focus on non-alignment and diversified partnerships. And we've seen other countries do this quite successfully, so the likes of India and Saudi Arabia. Another factor that South Africa needs to focus on in this environment is the appointment of ambassadors and really strengthening that personnel. So, employing more people that are going to be in charge of trade negotiations because we are in that environment that is going to need more of that. From a global perspective, investors are not only looking at economic fundamentals, but they are also looking at political alignment and credibility. So, South Africa is still investable, but it's just that capital is now more cautious globally.
So, foreign affairs playing a far more pivotal role this year. Lastly, looking ahead, South Africa's rand surprised to the upside more recently, supported by a favorable commodity price mix. Now, how might these gains, combined with a potentially stronger than expected fiscal position, influence sovereign ratings and boost investor confidence?
Starting on the fiscal side, so the commodity price windfall is expected to then support corporate income tax. So we are expecting to get higher corporate income tax revenues. That, together with higher value added tax revenues, will then lead to higher government revenue. And in turn, then it will lower the government deficits. So we are expecting that the budget will be tabled on the 25th of February this year, 2026. If the budget comes out with a clear commitment to fiscal consolidation, this will be viewed quite positively by credit rating agencies. For now, we have all three major credit rating agencies, and they all have South Africa as sub-investment grade. But I think the direction of travel is quite positive here, and it's improving. A return to investment grade will likely take time because apart from fiscal dynamics, what the credit rating agencies are also looking out for is improvement in growth, improvement in GDP per capita, but also fixed investment, which we have been lagging there. So we need progress in that regard. From a confidence perspective, we are seeing that investor confidence and business confidence has actually improved. And this is on the back of the improved ratings outlook, South Africa's removal from the Financial Action Task Force grey list, and from the EU high jurisdiction list. The path here, I think we are on a positive path, but it's gradual. So we are not expecting any sudden step change.
So, the direction of travel is positive. I think that is a nice key takeaway for our viewers today. As South Africa navigates a more fragmented global order and with domestic policies under the microscope, 2026 will test how well we balance global pressures with local priorities. Thank you, Tshiamo, for guiding us through these insights today.
Thank you, Sanisha.
Thank you for being with us today. Until next time.